we're going to continue discussing international finance. So we're going to think a little more about this idea of a balance of payments. What do we mean by things having to balance? Well, the current account plus the financial account has to equal zero. Remember, we think about current account as being sales by that people or businesses want. And we think about financial account as being investments. So why does it have to balance at zero? Well, when someone in the US spends money on something, the person in the other country uses that money for something. You can buy US goods, they could invest in a US business, they could invest in US treasuries, they could invest in US currency. So all the money that goes overseas, the people overseas who get it must do something with it. And so let's go ahead, and one other thing we notice here, if you remember, we saw this spreadsheet before, and for the United States, we show a current account of negative 481, a financial account of 406. You'll notice there's a difference here, right? This is not positive 481. We have this, what we think of as a statistical discrepancy. It's just when we try to calculate this, when we try to calculate this, they don't necessarily equal the same things just because of limited data, because methods of calculating the current account and the financial account are perfect. There's often some lag between when the payment happens and when it is recorded. It also can be difficult to identify foreign purchases of U.S. assets. So if someone in another country buys a business that's owned in the United States, it may be difficult for the people who are trying to compile these statistics to see that. So let's look at an example. Samsung makes televisions in China, sells them to the US for $1,000, and uses that income to buy US savings bonds and hire an American engineer to work temporarily in Japan. How does that affect the US balance of payments? The answer here is D. Let's see why that is. Why is it that the current account decreases by 500 and the financial account increases by 500? Notice that current account plus financial account has to equal zero, and that's what we have here. One goes down 500, one goes up 500. Let's think about, for each of these transactions we talk about in the problem, where they fit. So first, $1,000 in television sales. That is a purchase by the United States of goods made in other countries. So when you hear about the trade deficit, this is the kind of thing people are talking about. Our money goes overseas to buy stuff. So there is a debit to purchase of goods and services, which is part of the current account. So if we think about that as a net, that is a number on the left side of the balance sheet. That's money spent by the US on stuff. Okay. The Samsung then buys $500 in savings bonds. So that's money coming back to the US. That is a credit. And because this is an investment, it goes to the financial account and not the current account. Samsung also spends $500 hiring an American engineer. So that is a credit to factor income. That's money that a business is paying a person to help out the Japanese business. So that's a credit to factor income. That is money flowing from Japan to the United States. So it's a credit. Factor income is part of the current account. So let's summarize these three transactions. So on net, the current account decreases by 500. It went down 1,000 because of the television sales. That was the $1,000 debit. It went back up by 500 due to hiring the engineer. So that's a net of negative 500, so it decreases by 500. The financial account, we have positive 500 because of the purchase of savings bonds. So the financial account increases by 500. So if one goes down 500, one goes up 500, current account plus financial account equals zero. Next, we can look at trade deficits. The first question is, are trade deficits bad? The U.S. has a current account deficit, and it has been, as has been noticed by politicians of both parties, the U.S. has a goods trade deficit of almost $900 billion. So essentially, when you see this number, that is trying to think of the biggest, scariest number, because if you go to this section here, sales and purchases of goods and services. Well, the United States has a $500 billion deficit there. Well, the United States actually has a surplus if you just think about the trades of services. It has a really big deficit when you think about the trades in goods. Essentially, most of what the U.S. exports, or a lot of it, is services. Financial services and consulting services, things like that. So there is a goods trade deficit of almost $900 billion. The current account deficit is about $481 billion. Is this bad? Question to think. Is this a thing we should actually be concerned about? Well, let's think about what this identity means. So what does it mean for current account balance plus financial account balance equals 0? Well, a current account deficit means a financial account surplus, right? So if you're saying we have a $500 billion trade deficit, you could also be saying we have a $500 billion financial account surplus. And let's think about that. We send money over to China for stuff. And the Chinese businesses and citizens can do two things with the dollars they are paid. They can buy U.S.-made goods, so that will increase the U.S. current account, or they can invest in U.S. companies or U.S. government bonds, which increases the U.S. financial account. And I think what a lot of economists will say, it's not clear why one is better than the other, right? So the top one, if they opt to do this, that will reduce the trade deficit, reduce the current account deficit. And if you're just kind of scoring and you think a big current account deficit is bad, then I guess this is the one you're going to prefer. But it's not really clear why one is better than the other. And so let's think a little more about this, and let's think about, I call a summary of viewpoints. So a couple of different, both reasonable ways you could think about the trade deficit and financial account surplus. Optimistic is the U.S. is a great place to invest, which is why foreigners purchase so much American capital. So people in other countries would rather own U.S. bonds. They think they're a better, safer investment, so they're buying U.S. bonds. And that's a good thing. We want our bonds and our businesses to be thought of as great places to invest. The pessimistic view is that foreigners are investing in the U.S. because Americans are saving too little. So essentially, Americans aren't investing enough, they're consuming too much, not saving and investing enough. And too many assets in the U.S. are foreign owned. Overall, I think I would argue that most economists do not think that trade deficits are bad. And in fact, we all run trade deficits, both permanent, like with your grocery store, and temporary with your student loan company, right? Unless you work at a grocery store, if I calculate your balance of payments with the grocery store, you have a trade deficit. You keep giving them money, they're never giving you money. But they're giving you stuff, and that's a transaction both of you are happy with. You're running a temporary trade deficit if you have student loans right now. Actually, you're running a temporary trade surplus if you have student loans right now, right? Right now, student loan companies sending you money. Most of it's going to MSU, but that is a trade surplus for you. Eventually, when you start repaying those, then you'll have a trade deficit because you'll be sending them money.